Okay, let's get into this. I want you to just, for a second, close your eyes. Picture this. You've just pulled off the perfect heist. I'm talking, a proper Hollywood-style job.
The full 9 yards.
Exactly. You've cracked the safe, you've dodged the laser grid, you've squealed away just as the sirens start wailing in the distance. And now you're sitting in some quiet, dimly lit room, maybe a basement, and in front of you, there's a suitcase.
The classic suitcase.
The classic suitcase, and you click open those latches, and inside, just staring up at you, is $5 million. Used bills, non-sequential, the whole deal. Your heart is pounding. You feel like you're on top of the world. You did it. You won.
And right there, that's where I have to kind of burst your bubble.
Ah!
Because in the real world, you haven't won a thing. Not yet.
Exactly. And that right there is the premise that totally hooked me on today's deep dive. We always think the crime itself, the robbery, the embezzlement, the insider trade, we think that's the hard part. But the source material we're looking at today, it argues that the crime, well, that's actually the easy part.
Relatively speaking, yeah.
The truly hard part, the absolute nightmare scenario, it's trying to spend that money.
It is the fundamental paradox of all financial crime, isn't it?
Yeah.
You have possession of immense wealth, but you have zero ability to use it. You're a millionaire in that basement, but the second you step outside, you're just a target holding a bag of evidence.
You can't just, stroll into a Lamborghini dealership with a duffel bag full of cash.
You'll be arrested before you get a test drive.
Right. You can't buy a penthouse apartment. You can't even go to the supermarket and buy a cart full of groceries without someone eventually asking, hey, where'd you get all those crinkled up $100 bills?
Precisely. If you try to use the money in its raw, dirty form, you get caught. To actually enjoy it, you have to transform it. You need to make it look like you earned it selling, I don't know, cupcakes or consulting services.
And that magical process, that financial alchemy of turning dirty cash into clean spending power, that is what we are diving into today. We are looking at a set of documents from the NISM IFSCA certification course, specifically the foundational concepts in Chapter 1. We're unpacking the whole world of anti-money laundering, or AML, combating the financing of terrorism, CFT, and this one was new to me, PF, proliferation financing.
It sounds like a lot of, regulatory alphabet soup. I get that. But when you really dig into the NISM IFSCA material, especially this first chapter, it reads less like a textbook and more like a blueprint for a global financial war.
That's a great way to put it.
It really is. It's about how the entire global system has built this huge, mostly invisible net to try and catch this dirty money. And of course, how the criminals are constantly, endlessly trying to find ways to cut holes in that net.
And we're going to look at this through a very specific lens today. How all of this applies to India's brand new financial frontier, the International Financial Services Center, or IFSC.
Which is such a critical angle. The IFSC, places like Gift City in Gujarat, it's designed to be a world-class global financial hub. But to be a hub, to attract the big players, you have to be squeaky clean. The reputational stakes they're immense.
So our mission today is simple. We're going to follow the money. We'll break down exactly how the bad guys wash their cash, from the street-level stuff all the way up to massive, complex international fraud. And then we look at the shields, the laws, the agencies, the whole system designed to stop them.
Sounds like a plan.
But first, before we get into the mechanics of the wash cycle, we have to define the beast itself. What exactly is money laundering? We hear the term all the time.
We do, and the precise definition really matters here. If we look at the source, it points directly to the Vienna Convention, which gives a very specific legal definition and calls it the conversion or transfer of property, knowing it is derived from an offense, to conceal its illicit origin.
Okay, so I want to park on that word, conceal. It's not just about spending the money, it's about hiding where it came from.
That's the absolute crux of it. It is all about breaking the chain of evidence. The whole point is to legitimize these ill-gotten gains. Or criminals want to enjoy their profits, by the yacht, the mansion, whatever.
Right.
But they need to do it without jeopardizing the source of that money. They have to sever the link permanently between the original crime and the new asset.
There was one detail in the source that it completely blew my mind. I think it perfectly frames how desperate this whole process is for criminals. It talked about the cost of business.
Ah, yes, the shrinkage.
The shrinkage. I couldn't believe this. The source says that criminals are often willing to accept a 50% shrinkage in the wash. 50%.
Let's just pause on that for a moment, because the economic implication there is staggering. Imagine you run a normal, legitimate business. You sell shoes.
Okay.
Would you be willing to pay a 50% tax on every single pair of shoes you sell just for the privilege of putting that money in your bank account?
No, I'd be bankrupt in a week. It's an insane margin.
It is an insane margin. But for a money launderer, it's an acceptable cost. If you've just stolen $10 million, you are more than happy to walk away with $5 million clean, usable dollars.
It means the dirty money it's effectively trading at a 50% discount.
Exactly. It proves that illicit cash is not an asset. It's a liability. It's dangerous. It's heavy. It's evidence that can send you to prison. Clean money, even if it's half the amount, is a genuine asset. That 50% they lose, that's the premium they pay for safety, for legitimacy, and for finally being able to integrate into the real economy.
That is just a wild way to think about it. An entire global industry built on being fantastically inefficient. So, okay, let's get into the how. How do they do it? The source lays out a very clear classic process. It calls it the 3 stages of money laundering.
Right. And, the source is careful to point out that in the real world, these stages can bleed into each other. They can happen all at once.
Sure, it's messy.
It's very messy. But for understanding the theory, and certainly for anyone studying for the certification, we break it down into 3 distinct phases: placement, layering, and integration.
I love this because it sounds just like a literal washing machine cycle. You've got your dirty clothes, you put them in, that's placement. You spin them around with soap and water to get the dirt out, that's layering. And then you take them out, fold them, put them away, integration.
That's a perfect analogy.
So let's start with the first part of the cycle. Stage 1, placement.
This is almost always called the riskiest phase, and for very good reason.
Okay, why is it so risky?
Because this is the moment the physical world of crime meets the digital world of finance. This is where the criminal is at their most vulnerable. You remember our guy in the basement with the suitcase?
Yeah.
He's holding the smoking gun, the bulk cash. His one job is to get that physical currency into the legitimate financial system without setting off a single alarm bell.
And the whole system, the banks, they're designed specifically to ring those alarm bells, right?
Yeah.
If I walk in with a bag of cash, someone's going to notice.
Someone is definitely going to notice. They're going to press a button. So you need techniques to get around that. The source mentions a few, but the most famous one, the one everyone's heard of, is smurfing.
It sounds like a cartoon. I promise you we are not making this up. But it is a very serious financial crime.
It's named after the Smurfs because it involves a large group of small actors. In banking terms, you'll also hear it called structuring.
So how does it actually work?
Well, see, most countries have laws about cash reporting. In the U.S., it's any transaction over $10,000. In India, under the rules we're looking at, there are very strict reporting norms for cash deals over 10 lakh rupees. If you deposit more than that, the bank is legally required to file a report with the government.
A cash transaction report, a CTR.
That's the one. So if I have, say, 50 lakh rupees to launder, I can't just deposit it all at once. That's instant red flag.
So you smurf it.
You smurf it. You break that 50 lakh down. You hire, 20 people, your smurfs, and you give each of them a small amount of cash, say 40,000 rupees, well below the reporting threshold.
And you just send them out.
You send them to 100 different bank branches all over the city on the same day. Each individual deposit is tiny. It's insignificant. It flies completely under the radar. But at the end of the day, you've collectively moved a massive amount of cash from your suitcase into the banking system.
That just sounds so exhausting. You have to manage all those people, trust them not to run off with your money.
It's incredibly labor intensive. It's risky, which is why more sophisticated criminals prefer a different placement method: commingling.
This is the one that always makes me think of Breaking Bad and the car wash.
It is the Breaking Bad car wash scenario, 100%. It's a brilliant, completely illegal strategy. You find a legitimate business that is naturally cash heavy.
Like a restaurant, a bar, a laundromat.
Exactly.
Yeah.
A car wash, a vending machine company. Any place where a lot of cash changing hands is normal and expected.
And the key, as the source points out, is that they have low variable costs.
Crucial point. If you run a car wash, what's the actual cost of washing one extra car? A little bit of water, a little bit of soap. It's practically zero. So it's very hard for an auditor to prove exactly how many cars went through that tunnel on a given Tuesday.
So if I'm the criminal owner, I take my drug money.
And at the end of the day, you just mix it into the cash register with the legitimate earnings from the car wash. You take this big bag of commingled cash to the bank and you deposit it. You say, wow, we had a fantastic day, washed 500 cars today.
But in reality, you only washed maybe 200. The rest is just dirty money you've added to the pile.
Correct. But from the bank's perspective, it just looks like a successful business having a good day. They deposit it, and just like that, your dirty cash is now on the books as business income. You'll even pay taxes on it to make it look completely legitimate.
That's incredibly devious. The source also mentions a couple of other placement methods, mules and asset purchase.
Mules are basically just human smugglers, often used to physically carry cash across borders. But asset purchase is more interesting. It's about changing the form of the illicit wealth.
What do you mean the form?
Well, trying to smuggle a suitcase full of cash is difficult. It's bulky, it's heavy, it's obvious. X-ray machines at airports will pick it up.
So you buy something else with the cash first?
Exactly. You buy something with a high value-to-weight ratio. Gold, precious gems, high-end art. You can carry $1 million worth of flawless diamonds in a tiny velvet pouch in your pocket.
So you're not laundering it yet, but you're moving the value to a different country, maybe one with weaker rules where it's easier to get it into the system.
That's it. You've placed the value into a more portable, less suspicious asset that you can deal with later.
Okay, so let's say we've done it. We've survived placement. The money is now in a bank account, maybe mixed in with the revenue from our fake car wash. Now we're on to stage 2, layering. The source calls this the confusion phase.
I like that name for it. If placement is about getting the money into the system, layering is all about hiding where it came from,
Creating distance.
creating as much distance and complexity as possible. The goal is to build a web of transactions so convoluted, so dizzying, that no financial investigator could ever realistically untangle it.
You're trying to bury the needle not in a haystack, but in a haystack made entirely of other needles.
That is a perfect way to put it. You are deliberately trying to obliterate the audit trail.
The source mentions some really high-tech methods for this. The first one is chain hopping.
This is the new frontier. This is money laundering for the 21st century. In the old days, you just do wire transfers, from a bank in Switzerland to one in the Cayman Islands.
Right.
Now, you use cryptocurrency. Chain hopping is the process of rapidly moving funds from one crypto, like Bitcoin, to another, like Ethereum, and then to a privacy coin, like Monero, across multiple different blockchains.
So each hop is a separate transaction on a separate digital ledger.
Exactly. For an investigator to trace that, they have to somehow get data from all these different, often decentralized networks and piece it together. It is incredibly difficult, almost impossible with some currencies.
And what about mixing or tumbling services?
That's another crypto technique. A mixer, or tumbler, is a service that pools together crypto from many different sources into one big digital pot.
Like a cement mixer.
Like a digital cement mixer, yeah. It tumbles it all around, and then it sends you back the amount you put in minus a small fee. But, and this is the key, it sends you back different coins. The coins you receive have a completely different transaction history from the ones you put in. The link is broken.
It's literally a digital washing machine.
Yeah.
But, it's not all high-tech. The source also talks about some very traditional layering methods, especially shell companies.
Ah, the absolute classic tool of the trade. A shell company is a business that exists only on paper. It has no real office, no employees, no actual product or service. It's just a legal registration and a bank account.
And how does that help you layer the money?
You use it to create a series of fake but plausible transactions. Let's go back to our car wash. You've got that dirty money sitting in the car wash's bank account. You can't just leave it there. So your car wash wires $1 million to a shell company you control in, say, Panama.
But what's the reason for the wire transfer? You need an excuse, right?
Of course. And the invoice will say something plausible. Consulting services, market research report, logistics support fee. Since the Panama company is a complete fabrication, there was no service. But there's a paper trail, an invoice, maybe even a fake contract.
And from Panama, it goes somewhere else.
From Panama, it gets wired to another shell company in Singapore for software licensing. And that company then wires it to a family trust in the British Virgin Islands. Each step adds a new layer of complexity. This is also where the loan trick comes in, which the source mentions.
I found this one really clever. You're basically lending the money to yourself.
In essence, yes. Your shell company A loans $1 million to your shell company B. To an outside auditor, like a bank, it looks like a completely legitimate business loan. Oh, Company B is just borrowing capital to expand its operations.
But Company B has no operations. It's just you. You're just moving money from your left pocket to your right pocket and creating a legal document to justify it.
Precisely. And if anyone ever questions where Company B got its funds, you just show them the loan agreement. See, it's a loan. Perfectly legal.
Okay, so you've placed the cash, you've layered it through 50 different shell companies and crypto tumblers. The trail is completely cold. That brings us to the final stage of the cycle. Stage 3, integration, the grand return.
This is the victory lap. This is where the laundered money finally re-enters the legitimate economy. It now looks completely clean, completely normal. The criminal can finally start spending it without fear.
This is where they finally get to buy the yacht.
This is where they buy the yacht. Or, much more commonly, real estate. Real estate is a massive, massive vehicle for integration. You use the clean money from that final shell company, the BVI, to buy a luxury apartment in London or a villa in Dubai.
And once you own the property,
You now possess a tangible, clean asset. You can live in it, rent it out, or a year later, you can sell it. And the money you receive from that sale is 100% legitimate. If the tax authorities ask, where did you get this $5 million? You just show them the sale deed for the property I sold my apartment. The crime is now buried under layers of legitimate transactions.
the source also mentions a technique for integration that seems incredibly bold: fake employees.
It is bold, but it's very effective for solving a specific problem. How do you get day-to-day walking around money back into your own pocket?
So you hire yourself.
Or your relatives, or just completely fabricated identities? You put these ghost employees on the payroll of one of your seemingly legitimate front companies. The company pays them a handsome monthly salary. It even properly withholds and pays income tax and Social Security on that salary.
And paying the taxes is what makes it look so real.
It provides the perfect cover story. If anyone asks how you afford your lifestyle, you're not a criminal. You're a highly paid international business consultant for Global Ventures Corp. Here are my pay stubs to prove it.
It's fascinating and terrifying how much thought and infrastructure goes into all of this. But there's one specific method that the NISM IFSCA material dedicates a whole section to, and it seems to be this enormous blind spot in the global system: trade-based money laundering, or TBML.
TBML is often called the sleeping giant of financial crime. The scale of it is almost impossible to comprehend.
So I have to ask the obvious question here: why? Why would you bother with all the hassle of international trade shipping containers, customs forms, port authorities, when you can just click a button and move numbers on a screen?
Because the world of clicking buttons, the formal financial system, is now incredibly heavily monitored. There are sophisticated algorithms watching every single wire transfer for suspicious activity. But trade is ancient, it's physical, and it is beautifully, wonderfully messy.
What do you mean by messy?
Just think about the sheer volume. Millions and millions of shipping containers are moving around the globe every single day. Customs officials can only physically inspect a tiny, tiny fraction of them. We're talking less than 5%, often less than 2%.
So it's the ultimate haystack to hide your needle in.
It is. And unlike a financial transaction where a dollar is a dollar, the value of goods in trade is subjective. Prices fluctuate. Quality differs. It's much harder for a bank's compliance officer to know if a shipment of textiles from Bangladesh is really worth $100,000 or if it's actually worth $500,000. That ambiguity is what criminals exploit.
The source breaks this down into 4 basic techniques. I think we should walk through them because this is where the crime gets really clever. The first one is over and under invoicing.
This is the bread and butter of TBML. It's a simple, elegant way to move value across borders disguised as legitimate commerce.
Okay, let's walk through an example. Let's say I'm a criminal in India and I need to get $1 million to you, my partner, in some other country. But I can't just wire it.
Right, the banks would flag that. So we set up a trade deal. I'm going to export something to you, let's say, a shipment of machine parts.
Okay, so I'm importing machine parts from you.
Now, in the real world, on the open market, these parts are worth exactly $1 million. But I am going to create and send you an invoice for $2 million.
That's over invoicing. You're charging me double the real value.
I am. You then take that official-looking invoice to your bank in India. The bank sees what appears to be a legitimate invoice for a trade transaction. They approve the payment. Your company sends my company $2 million.
And then you ship me the parts?
Then I ship you the machine parts, which are only worth $1 million. So let's look at what just happened. On paper, we completed a trade deal. But in reality, you sent me $2 million, and I only sent you $1 million of actual value. We have successfully moved $1 million of illicit value from your country to mine, completely hidden inside a trade payment.
And to the bank, it just looks like I'm a bad negotiator who overpaid for some parts.
Exactly. Unless that bank compliance officer also happens to be an expert in the global market price for those specific machine parts, they will never, ever catch it.
And I assume under invoicing is just the reverse.
It's the exact opposite.
Huh.
If I need to move value to you in India, I will ship you $1 million worth of goods, but I'll send you an invoice for only $500,000. You pay the artificially low price, but you receive the high-value goods. You can then sell those goods in India for their true market price of $1 million.
Where
I have effectively transferred $500,000 of value to you, disguised as a bargain.
it's so clever because the goods are real, the shipment is real, everything is above board except for the numbers on one piece of paper.
But then you have the next level, which is over and under shipments. This is where the fraud moves from the paperwork to the physical container itself. The documents might say 1,000 laptops, but the container only actually holds 500.
Or, as the source puts it, phantom shipments.
The empty box scenario.
Yeah.
This is pure fraud. The documents are absolutely perfect. You have the bill of lading, the insurance certificate, the packing list. You present this perfect package of documents to the bank to get financing. The bank processes the payment based on the documents.
But the container's full of bricks. Or just air.
It's empty, or it's filled with worthless junk to match the declared weight. Banks operate on the basis of documents, not the physical goods. They don't have staff down at the port opening containers to check the contents. That is the fundamental vulnerability that gets exploited.
And the last one the source details is falsely described goods. This feels like the classic movie trope of swapping the diamonds for fakes.
That's the perfect analogy. You ship low-quality industrial diamonds, but the invoice and customs declaration describe them as high-grade jewelry-quality gems, justifying a much higher price. Or you ship high-end electronics, but describe them as cheap plastic toys to justify a lower price and transfer value the other way. You're misrepresenting the quality to manipulate the value.
So we have the crime, we have the incredibly complex wash cycle, we have this massive trade fraud. It really sounds like the criminals have all the advantages. But this is where the source material pivots, right? It starts talking about the global shield, the good guys.
Absolutely. The world is not just sitting back and letting this happen. Over the past 50 years, an incredibly complex and powerful international architecture has been built to fight this.
And it all started, according to the source, way back with the Bank Secrecy Act, BSA, of 1970 in the United States. It's like the grandfather of all modern AML laws.
The BSA was truly revolutionary for its time. You have to remember, before 1970, the global standard was banking secrecy. The Swiss model. What you did with your bank was your business. The BSA completely flipped that. It said, no, if a cash transaction of more than $10,000 happens, the government has a right to know about it.
Which seems like common sense now, but back then it was a huge deal.
It was a monumental shift. But interestingly, the source notes that the law kind of sat dormant for its first decade. It wasn't until the 1980s, the era of the massive drug cartels, the Pablo Escobar era,
Right.
that law enforcement really weaponized it. They realized they couldn't stop every shipment of drugs, but maybe they could stop the flow of money, choke off the financial lifeblood, and the BSA became the blueprint.
Then, on the international stage, you have the Vienna Convention in 1988.
This was the first major global step. And its key contribution was that it explicitly linked money laundering to drug trafficking. It created an obligation for all signatory countries to make it a specific crime, to launder the proceeds of the narcotics trade. Before this, in many jurisdictions, it wasn't even technically illegal.
But the real heavy hitter, the organization whose name is all over this source material, is the FATF, the Financial Action Task Force.
The FATF is the nerve center of the entire global AML CFT system. It was created by the G7 in Paris back in 1989. And their mission is to set the global standards. They don't have police powers. They don't arrest anyone. They write the rule book that they expect every country to follow.
And they have real teeth, don't they? They have these infamous lists.
The naming and shaming mechanism. It is their most powerful weapon. If a country is found to have weak or deficient AML laws and enforcement, the FATF can place them on the gray list.
I see this in the news all the time. You know, country X has been added to the FATF gray list. What does that actually mean for the country on a practical level?
It means a world of financial pain. It's a massive red flag to the entire global financial community. It says, be extremely cautious when doing business with this country. It makes it harder for that nation to get loans from the IMF or the World Bank. It scares away foreign investment. It increases the cost of doing business for all of their banks.
So it's like a credit rating downgrade for an entire country's financial integrity.
That's a great way to put it. And if they really fail to comply, if they're actively hostile to the standards, they can be put on the blacklist, alongside countries like North Korea and Iran. And that is essentially financial excommunication. You are cut off from the global banking system.
The source also points out a critical evolution for the FATF in 2001.
Yes, immediately after the 9/11 attacks, the world woke up to a new threat. And the FATF's mandate was immediately expanded from just focusing on anti-money laundering, AML, to include combating the financing of terrorism, CFT.
What's the real difference between the two? It sounds like they're both about stopping bad guys' money.
It's a subtle but absolutely critical distinction. Money laundering is usually about concealing the illicit source of the funds. You're trying to make dirty money from a crime that has already happened look clean.
Okay, sure.
Terrorist financing can be the opposite. It's often about concealing the illicit destination or purpose of the funds. The money itself might be from a perfectly legitimate source, charitable donations, someone's salary, profits from a small business.
So the money's clean to begin with.
It can be.
Yeah.
But it's being sent to a bad cause, to buy weapons, to fund an operative, to plan an attack. So the challenge for investigators is different. You're not looking for a criminal trying to legitimize past crimes. You're looking for suspicious financial flows moving towards future crimes.
That makes a lot of sense. So that's the global architecture. Let's zoom in now and talk about the Indian fortress. How has India implemented these global standards?
The absolute cornerstone of India's framework is the PMLA 2002. That's the Prevention of Money Laundering Act.
Enacted in 2002, came into force in 2005. Now, there's a concept in the source that I need you to unpack, because at first glance it seems like a giant legal loophole. The idea of the scheduled offense.
Ah, yes, the predicate offense. This is a fundamental concept in Indian law.
The source seems to be saying you can't just be charged with money laundering on its own. It has to be connected to some other underlying crime, a scheduled offense.
That is exactly right. In India, money laundering is considered a derivative crime. It is dependent on the existence of a prior primary crime that generated the dirty money.
So just to be clear, if I'm a police officer and I find a guy with a suitcase full of cash, and I know it's dirty, but I can't prove exactly which crime it came from, I can't charge him under the PMLA.
In principle, for the Enforcement Directorate, the ED, to build a PMLA case, they must demonstrate that the money constitutes proceeds of crime that were derived from one of the specific offenses listed in the schedules of the Act.
What kind of crimes are on that list?
It's incredibly comprehensive. It's broken down into parts A, B, and C. Part A has the really serious stuff offenses under the Indian Penal Code, like waging war against the state, major criminal conspiracies, plus crimes under the Narcotics Act, the Prevention of Corruption Act, even the Wildlife Protection Act.
In Part C, the source says that's for transborder crimes.
Yes, and that's crucial for our discussion on international finance. Part C ensures that if a crime is committed outside India, say, a massive fraud in London, but the criminal brings the proceeds of that crime into India to launder them, the PMLA can still apply. It prevents India from becoming a safe haven for foreign criminals to watch their money.
So we have the law. Who does the watching? The source introduces us to the FIUIND, the Financial Intelligence Unit of India.
The FIU is best understood as the central brain of the system, not the muscle. They don't kick down doors or make arrests. They're a data analysis agency. The source calls them the central reception point for all financial intelligence.
And they receive all these reports we hear about, CTRs, STRs, NTRs, more alphabet soup.
Let's decode it. It's simple. CTRs are cash transaction reports. Any cash transaction over 10 lakh rupees, the bank has to report it. STRs are suspicious transaction reports. This is the crucial one. It's not based on a threshold. It's based on judgment. If a bank manager sees a series of transactions that just feels wrong, it's unnecessarily complex, it's unusually large for that customer, it has no apparent economic rationale, they are legally obligated to file an STR. And NTRs are nonprofit transaction reports, specifically to monitor charities and NGOs for potential terrorist financing.
So the banks and other financial institutions are sending millions of these reports to the FIU. What happens then?
The FIU ingests all this data and uses advanced software and human analysts to look for hidden patterns, networks, and anomalies. They're looking for that needle in the national haystack. When they find a credible lead, a network of suspicious activity, they package that intelligence up and disseminate it to the relevant enforcement agency.
So they pass it on to the Enforcement Directorate, ED, or the CBI, for the actual investigation and prosecution.
Exactly. The FIU provides the lead, the ED kicks down the door, and the source mentions the specific technical platform for all this is called FinGate 2.0.
FinGate 2.0.
That's the secure digital portal. Every single reporting entity in India, every bank, stockbroker, casino, insurance company, has to register on FinGate 2.0. It's the mandatory electronic gateway for them to submit all these reports. It's what allows the FIU to operate at scale.
Okay, so we have the global rules from FATF, we have the national law with PMLA. Now we get to the real heart of our source material, the thing that makes this deep dive unique, the IFSC, the International Financial Services Center.
The new frontier, as you said.
I think for a lot of our listeners, IFSC might just be another acronym they've heard. We hear about Gift City in the news. What is it really, and why does it need its own special chapter on AML?
So an IFSC is a special economic zone that is set up to cater to customers outside the domestic economy. It's a jurisdiction that deals primarily in finance across borders. Think of established global centers like the DIFC in Dubai or Singapore or the City of London.
But this one is physically located in India.
Yes. Gift City, the Gujarat International Finance Tech City, is India's first fully operational IFSC. So while it's geographically in Gujarat, from a legal and financial regulatory perspective, it's treated as if it were an offshore jurisdiction.
Hold on, so it's like a small piece of a foreign country inside India.
In terms of financial rules, that's a good way to think about it. The regular domestic Indian economy has capital controls. You can't just freely convert unlimited rupees to dollars. But inside the IFSC, it's a hard currency zone. Business is conducted in dollars, euros, yen. It's designed for global capital to flow in and out with minimum friction.
And it has its own single unified regulator, right? The IFSCA.
And that is the absolute key differentiator. In the rest of India, you have a fragmented system. The RBI regulates banks, SEBI regulates the stock markets, IRDI for insurance, and so on.
But in the IFSC, they just combine them all into one.
Exactly. The IFSCA, the International Financial Services Centers Authority, is a unified regulator. It has been given the powers of RBI, SEBI, IRDI, and PFRDA, all rolled into one body for the specific jurisdiction of the IFSC. The idea is to be more agile, faster, and less bureaucratic for global businesses.
But this raises the big question, and the source is very clear about this. If you create an offshore, frictionless financial center, aren't you just rolling out the welcome mat for dirty money? Doesn't it risk becoming a tax haven or a laundering hotspot?
That is the billion-dollar question, and the source and the Indian government's entire strategy is built on ensuring the answer is an emphatic no. In fact, for Gift City to have any hope of succeeding, for it to become a credible global financial center, it must be seen as being more compliant, more transparent, and more stringently regulated than anywhere else.
Because reputational risk is everything.
It's the only thing that matters. If Gift City gets a reputation, however small, as a place to wash money, the big global players, the JP Morgans, the Goldmans, the HSBCs, they will not touch it. They simply cannot afford the risk to their own reputations. So the IFSCA has issued its own very strict guidelines, the IFSCA, AML, CFT, and KYC Guidelines 2022.
The source really emphasizes a risk-based approach in these guidelines. What does that actually mean in practice compared to just, following a list of rules?
A rule-based approach is just a checklist. Do they have a passport copy? Check. Do they have a utility bill? Check. Okay, open the account. It treats every single customer exactly the same.
Okay.
A risk-based approach, RBA, is much more intelligent. It requires the financial institution to think. It asks, who is this customer? What is their business? Where is their money coming from? Does this transaction make sense for them?
So give me an example.
Okay. A 21-year-old student with no job history walks in and tries to open an account with a wire transfer of $5 million. The rule-based approach might just say, well, his ID is valid, so it's fine.
But the risk-based approach would have sirens going off.
Exactly. The risk-based approach says, this is a massive red flag. Where did a student get $5 million? Is he a front for someone? Is he a mule? Is this a high-risk client? You have to categorize your customers. Low risk, medium risk, high risk.
A big publicly listed company would be low risk.
Probably. But a politically exposed person, a PP like a senior government minister or their immediate family, is automatically considered high risk. You have to conduct enhanced, ongoing due diligence on them. You have to scrutinize their transactions much more closely.
The source also mentions some interesting exemptions, like foreign universities setting up campus in the IFSC.
Yes, that's a good point. A foreign university campus operating in Gift City is exempt from some of the direct AML reporting duties because it's not a financial institution in the traditional sense. But, and this is very important, but they are still required to conduct a full business risk assessment. They're not completely off the hook. They have to analyze their own operations and assess the risk that their tuition fee payments could be used as a vehicle for money laundering.
It really feels like they are trying to thread an incredibly fine needle here. They want to be easy to do business with, but have these incredibly high walls against financial crime.
That is the fundamental balancing act of modern global finance. Frictionless, but fortified.
So if we just zoom out one last time, we've gone on this journey from a guy stuffing cash into different bank accounts, smurfing, all the way up to the high-level global architecture of the FATF and the hyper-modern, digitally focused fortress being built in Gift City.
It's a perpetual arms race. As the regulators and law enforcement build better walls, like FinGate 2.0 and the global information sharing networks, the criminals just invent more creative ladders, like crypto chain hopping or incredibly complex trade-based fraud schemes.
And the big takeaway for me, after going through this source material, is that money laundering isn't just some abstract crime about rich criminals getting richer. It's about protecting the integrity of the entire financial system.
Absolutely. If the legitimate financial system is flooded with dirty money, it distorts everything. Legitimate businesses can't compete with criminal enterprises that don't need to make a profit. Trust in the system erodes. The laws we've talked about, PMLA, UAPA, and the bodies that enforce them like the FIUIND and the IFSCA, they are essentially the antibodies of the financial system, fighting a constant infection.
That's a great analogy. The system is so vast, from that initial risky placement of cash to the final seamless integration through a luxury real estate purchase.
And we have to remember, the end goal for the launderer is always that integration. It's to make the abnormal look completely and utterly normal.
Before we wrap up, I want to leave you, our listener, with one final thought. We spent a lot of time talking about trade-based money laundering, lying about the price of physical goods, over-invoicing solar panels, under-shipping laptops.
Right.
But we are rapidly moving into an economy based on digital assets, on intangible services, consulting hours, NFTs, lines of software code.
The intangible economy.
Exactly. Now, if I sell you a physical painting, you and I can have an argument about whether it's really worth $1 million. But if I sell you a JPEG of a cartoon ape or 1 hour of strategic consulting, how can a bank or a customs official or an auditor possibly know the true price of that?
That is the provocative question, isn't it? In a world of intangibles, value becomes purely subjective. And where value is subjective, money laundering becomes incredibly easy to disguise.
So is the next great frontier of money laundering already hiding in plain sight, right inside the digital economy?
I have a very strong suspicion it already is. And the regulators are going to have to run very, very fast to even begin to